So here's the question that financial markets are asking themselves after Kevin Warsh became the Federal Reserve Chairman, the head of the Federal Reserve, and had his first press conference last week on Wednesday. And the question is, are we entering a new era for markets now that Kevin Warsh is leading the Fed? This is the first change in a Federal Reserve Chairman in 8 years. And is this a new face or a genuinely different Federal Reserve? Our answer would be that this is a very different Federal Reserve than we've been accustomed to, especially over the last 8 years and potentially over the last 20 years. So on the surface, nothing happened last week on Wednesday. Interest rates stayed the exact same, which the markets had planned for. But the reason the market was down and volatile on Wednesday, which confused a lot of clients that I had conversations with last week, was that interest rates held steady. So why is the market reacting? Well, it's not the change in interest rates, it's the philosophy of the Federal Reserve that's changing underneath the surface. And there's three main areas that Kevin Warsh has been highlighting over the past couple of years, and specifically in his press conference on Wednesday. So I'll go ahead and cover that. The main takeaway from this is that, number one, as always, your financial plan is built specifically for you to account for all of these unknown variables, which is why we structure your investments between short-term, medium-term, and long-term investments so that you don't have to worry when these things are going on. And so that's the key takeaway, is that there will be probably some more volatility up ahead, especially as the market gets used to this new Federal Reserve Chairman. But again, that's why we have our regular meetings with you and we structure your investments in a way that money you don't need for 10 years is invested much differently than money that you're going to need to live on within the next 12 months. So with that, if you have any questions about this video or how your personal financial plan is impacted by anything, feel free to reach out to myself, Zachariah Montero, or any of the other advisors or whoever your current advisor is. And so with that, I'll get into the deeper part of the video for those of you who would like to hear some more on what is actually changing within the Federal Reserve. So point number one is the Federal Reserve acting as the last resort or the backstop for the financial markets is probably ending. And certainly if Kevin Warsh has his way, the Federal Reserve coming in to support financial markets in the middle of a downturn like we saw during COVID, Kevin Warsh would not want them to do that at all. And so that would be a huge change in the reaction function of the market and the expectations of the stock market and bond market if he is successful in doing that. And one of the ways he wants to accomplish that is by dropping what's called forward guidance. He doesn't want to do that at all anymore. Forward guidance is where the Federal Reserve essentially projects where they see interest rates going, where they project what the economy is going to be doing. And we all know this is futile. We can't do it. The Federal Reserve can't do it. 400 PhD economists at the Federal Reserve can't get interest rates or the economy right. How is anyone supposed to get the future right on this? And that's exactly his point, is the Federal Reserve shouldn't be projecting and making estimates on what or where they think things will be. He would rather have a much more opaque and less transparent Federal Reserve. And so he proved that by not putting his name or a vote on where he thinks interest rates will be going on the Federal Reserve dot plot. And so with that, as the market again gets used to this new normal with the Fed, we'll probably have some more volatility. Once the market is used to Kevin Warsh and his methods of communication and so forth, then that volatility will likely subside. It's always the unknowns that cause the volatility, typically, in the short run. The second thing is that he expects higher interest rates for longer. And he means it. He said verbatim, inflation is a choice. And the previous Federal Reserve basically waited on this too long and didn't raise interest rates high enough. And they sat on an inflation problem that they knew about, that they also contributed to. And really, they should have done something sooner and much faster and harder. If we want to look for historical parallels or analogies for what they are worth, if Jerome Powell was Arthur Burns of the early 1970s, Kevin Warsh is like Paul Volcker of the late 70s, early 80s. He would prefer to have a much more restrictive Federal Reserve when it comes to taming inflation. And he even referenced other methods of the Federal Reserve getting information instead of waiting for all of this data that comes in that has a very large lag on the economy. It doesn't really tell them where things are right now. It tells them where things were at 3 months ago. He said that's not even helpful. And we really want to get away from that. And so those are some of the changes he wants to make internally on how they make decisions, and really having a much more hawkish point of view towards inflation, opposed to being more accommodative, I should say, to inflation. And one of the ways he wants to accomplish that is with the third point, and that is he wants to have the Federal Reserve to have a much smaller footprint. He does not like that the Federal Reserve, when a press conference can move the markets, or that the Federal Reserve is the one basically bailing out the government anytime we have an issue ever since the financial crisis. He wants to completely get away from that. And the Federal Reserve's balance sheet has grown exponentially since the financial crisis. Not just in a straight line, but truly exponential growth. And he wants that to completely stop and for that balance sheet to shrink. So what they did in effect after 2007 through 2009 and also during COVID is the Federal Reserve is the one that would step in and start buying treasury bonds. Treasury bonds are just how the government finances its debt. The government can't go to a bank like we do to get a home loan or an auto loan. The government has to go to all of us, to other countries, to investment managers, to pension funds, to sell their debt in exchange for cash, and then the investor gets an interest rate, much like a CD. And here's the problem is, because these things happen during a crisis like the financial crisis or during COVID, and even in between that time when things were relatively stable, because all of those things happened, there was more supply of debt than there was demand for it. So you had a mismatch between sellers and buyers, which would have meant that the effects of the financial crisis and the effects of COVID would have been much more dramatic if the Federal Reserve had not stepped in to prop up financial markets. He wants to completely get away from that and lower the overall balance sheet, and again get back to a point where the Federal Reserve is somewhat non-important when it comes to financial markets, which is a much different world than we've lived in for the past 30 years, really since the late 1990s, early 2000s. And so this is a very big shift if he's successful in doing that. And he's also a big proponent within this of how he wants to lower the balance sheet, is he wants to give access to smaller banks, larger banks, and very large banks to be able to buy that treasury debt in larger quantities, so that the government doesn't have to be the lender of last resort. And he wants to lower regulations and increase deregulation of the financial services industry when it comes to banking and smaller banks, which in the long run would be a very good thing. We need those smaller banks to be able to support growth for the economy, especially when you consider most of the employers within the country are small businesses. Small businesses need those small banks to be able to provide financing and other methods to help them grow their business and get started. Without that, we're going to be left with just a few household name banks like Bank of America, JP Morgan, and so on. And he really wants to get away from that. And so the main point of volatility is from here to there when he accomplishes this, if he does, and if he is successful. But when we get there, if he is successful, we will have a much stronger, more robust financial and economic system, and it even benefits to our society overall as well if inflation is in fact able to come down and prices are able to stabilize and maybe even come down a little bit. And so those are the things that we're watching. That's our read on the current Federal Reserve switch from Jerome Powell to Kevin Warsh, and it's something we'll be paying very close attention to over the coming months and years ahead. So with that, I'll leave you until next time. Take care.